Welcome everybody, it's Jeff Beers from the 40 Finance channel. Today I'm going to take a devil's advocate view on 401k plans. The bottom line with the 401k, just like any investment strategy, it's not a one-size-fits-all. It's not a set it and forget it, solve all my problems thing. And that's what I want to look at today, which is something people don't talk about all the time, 401k disadvantages. So let's jump right in. All right, so the first thing to consider when looking over your company's 401k option is the fact that not all 401k plans are equal. What somebody's getting at one company might be totally different than what you're getting at yours. And so that's where you have to make a choice of how much you want to invest in it. So right off the bat, you've probably heard that some companies match a certain portion of your deposits in 401k. This can be a great way to get so-called free money, but not every company does it. And if not every company does it, you have to ask yourself, is this the savings vehicle that I'm interested in? If that option is not available for you, then it could change your perception of saving in a 401k when the so-called free money is gone. Number two is the vesting schedule. And this gets overlooked a lot too. So while 401ks at certain companies may have a match or a contribution, in some cases you could have to work at the company for 3 to 5 to 7 years to fully own the money that they put into it. So in other words, if you're at a company that has a vesting schedule of 3 years and you find a new job after 1, then the money that they contributed to your account will not follow you. Okay, that's part of sort of the golden handcuffs of keeping people in the same employer. So if you're young and you anticipate you'll be switching jobs or you're going to climb the career ladder as quickly as possible, then the matching contribution may never even end up in your wallet when you look at the plan, say 5 years from now. Next up, we have to look at what are the investment options for our 401k plan. I've seen quite a few, particularly in small businesses, that only give you 10 or 12 different options for mutual funds. And while those could be suitable for a long-term investment strategy, you have very little choice in terms of no-fee mutual funds or low-fee mutual funds. And if you're picking investment products that don't really match your goals and markets that you believe will rise in the future, then you're actually almost being forced to invest in strategies that you really don't even believe in. So make sure you understand what your investment strategies are with your 401k. And finally here, we have, of course, the fee structure. Now, fees come into play with every financial instrument. So 401ks are really not that much different from paying commission on stock purchases and ETF fees. But you do have to be careful because if your 401k pushes you towards mutual funds, then that's the kind of thing where you could be paying 2 or 3% per year, as opposed to an ETF that's only paying or that's only charging 0.53% per year. So there is some subtle differences, and if you're not careful, the difference between saving in a 401k tax-free, so to speak, versus the fees that you might face if you only have limited investing options in mutual funds with high fees, then that takes some of the advantage out of the equation, and you can be right back to square one or very close to it. The other big disadvantage of 401ks, in my opinion, is the withdrawal rules. And with these, there again, it's made to force you into saving for retirement, but everyone has different plans. And if you're raising a family like me, retirement isn't actually the first thing on my mind. So we have to be careful and make sure that we have access to our money when we need it. The current withdrawal rules for a 401k to avoid the most tax and penalties is 59 and a half years old. Okay, I'm 40-ish years old with 3 kids. That's 19 and a half years away. That's great for my retirement, but if something comes up before then, I'd like to have access to my money, at least the original deposits that I put in, okay? If you do take out early and you see the penalty here, you pay the taxes that you so-called avoided when you were making deposits plus another 10%. That's a tough nut to swallow if something very small comes up and you're forced to make a withdrawal. You're basically paying more than the money that would have landed in your paycheck, and a lot of people overlook it. Now, there is exceptions. If you have a healthcare need or certain other financial hardships, you can withdraw without the penalty. However, if it's something like your transmission fell out of your car or some other $2,000 to $3,000 expense, your withdrawal is actually going to cost you more than it would have cost you in your paycheck. I put a note here, not family friendly, and it kind of alludes to what I was saying before. When you have 3 kids like I do and you're running a house, the expenses of 3 children and the prospect that your children are going to have education needs, career needs, etc. way before you retire, I just don't think the 401k is super family friendly in that sense. There are some other avenues to save for education that get the same kind of tax benefits, but at the end of the day, it gets back to liquidity for me. I want to be able to go in and access the money that I put in there without paying additional taxes and penalty fees if a situation comes up where I can further my family either on the education side or otherwise help my children. So having your entire nest egg in a 401k would be severely limiting from a family perspective. You need to, in those cases, make sure, hey, take your 401k, get your company match, whatever you think's right for you, but make sure you have a lion's share of your savings in cash or a retail brokerage where you can access that money as you need it. Lastly is opportunity cost. So again, it's great to save up $300,000 in your 401k, let's say by the time you're 49 years old, 52 years old. Can't get to it without massive penalties until you're 59 and a half years old. So some of you guys who have interest in starting a business, okay, investing in real estate, things of that nature, don't count on your 401k to fund those because you'll actually lose with all the penalties that are coming in. So if you have ambitions of starting a business or investing in real estate, then your 401k money is way off limits for those things, and you're going to have to save on the side. Again, it doesn't mean don't put money in the 401k, but don't build your whole future in there because it's just too hard to get money out. And last but not least, on 401k disadvantages, at least in my opinion, everything changes, okay? Life changes so fast. If you're 25 years old and you start a 401k, that's great. The concept of you staying at the same business year after year after year, working your way through the investments, all those things, I actually think is probably a pretty low percentage, but I don't have the math on it to be fair. However, if you do transition careers in companies, yes, you can do a free transfer, say from your company's 401k to a Fidelity 401k. Transferring money from one place to the other is free. What everybody forgets though is reinvesting in new securities. When you get to that 401k, the new one, they're still going to charge you the fees. So if you're paying fees for mutual funds and 401k A, and then you moved it to your new job at B, transfer 100% free. Taking $50,000 and reinvesting it into the investment options at, say, Fidelity is going to cost you money. There's fees involved. So there is no free transfer, and there's a reason companies are always interested in moving you from one nest egg of money to the other. Next up, DCA, dollar cost averaging. That's not always the best way to invest. Look, time after time, the market goes up and down. We all know that. Dollar cost averaging is not a horrible strategy over long periods of time, but when you think about things like the recent spikes and bubbles that we've had in the stock market, those are actually times to not invest in the stock market. You're trying to get in low and sell high, right? And if your paycheck is always being forwarded on to a certain mutual fund or strategy, you have a limited option on how you're going to invest. So me personally, who follows the stock market every day, there might be certain bubbles where I'm like, hey, pause. I'm not buying any more of that investment option. Instead, I'm going to stockpile cash. And then when the market dips, I'm going to take my stockpile of cash and go buy more at that point when it's the lowest. Really hard to do if you're in an autopilot in retirement account. Another thing that changes right under people's nose is company stock fluctuations. So if you work for a big corporation, they don't force you to buy the company's stock, but that option is right there front and center. So if you work at, I'm just going to pick on Fidelity today. If you work at Fidelity and you have option to buy Fidelity stock and you're not careful and you buy all Fidelity stock because you're like, hey, I'm on the project management team and this project's awesome, we're going to make $1 million. That's great, but everyone knows that Fidelity, like every other company in America, is going to go through a roller coaster ride. Where they're at 20 years from now, there is no promises, right? So if you think about Enron and some of these other scandals that we've had in the past, people lost everything. Their 401k, they put it all in Enron, everything was great, money was being made until we found out that the accounting practices were subpar. Then the stock crashed. That means 401ks crashed for those people and they're out. So it's a gamble to invest in any company, any one company on any investing platform. The problem on 401ks in certain companies is that option's front and center, and people who don't think about it too much will put way too much money into those single companies. So just beware. Number 4 is tax brackets, and this is the last real disadvantage for today. So everyone makes the assumption, right, that if you're 25 years old, you're in this tax bracket, and when you retire, you'll be in this tax bracket, and everything comes out, you're getting taxed higher supposedly at 25 than you will be at, say, 60 years old. More than likely, this is true. However, those are the tax brackets of today, and we have no idea which way that's going to go. So to bank on that strategy alone, it can be a reason to invest in 401ks, right? But it can also be a disadvantage if things don't go exactly the way we hope they will. All right, so that's something to keep in mind. If you're planning for taxes and you're investing because you save on taxes on the way in, taxes on the way out, that world I would consider very unstable. And while you will likely come out ahead with the young to old strategy, it is not guaranteed, and the margins of that play could change dramatically by the time you get to the finish line. So guys, hope you enjoyed this. 401ks are not evil. There's a place for them everywhere. I definitely would not throw your entire life's ambitions into a 401k though. And again, this is just my opinion. You'll see plenty of videos on YouTube that say 401k is the greatest thing of all time. And if that's your take, then by all means, have at it. I could easily be wrong. But nonetheless, I hope you enjoyed this contrarian view. Please like and share with your friends. I'll see you on the next video.